Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. And I've been having a really difficult time the past 2 days. Normally I start working on my radio program on Friday afternoon and then I try to finish it up early Saturday morning. And there were so many articles that were so good, I could not choose. So I have a Bloomberg terminal. It's a really expensive tool to have, but I really like it a lot. If there's anything in the financial world that's going on, it knows it. It's got all the foreign currency exchange rates. It's got the Fed has a whole section on there so you can see all their interest rates and what they're currently thinking, what they're doing with the money supply, what they're doing with the reserve requirements, all that kind of stuff. And it's just mind-boggling. I mean, it is, you know, I'll look up and it's already been 2 hours since I started reading. And but I'm glad to have it because it does really help. And when you look at the amount of news that's out there, the vast majority of news is kind of bad. And, you know, that goes back to, I don't know, there's a journalistic view that bad news sells more ads than good news does. And, you know, that's pretty proven over the years. So it gets the attention of the average person. When you talk about a lot of good things, everybody has a tendency to go, "Oh, hey, things are good. Let's go do something else," instead of reading these magazine articles. So anyway, I forget. Anyway, my favorite publications, Bloomberg Business Week. Bloomberg end up merging a long time ago, and pretty good articles. I mean, it's really it's a lot makes it a lot easier. And then if I see something there that really catches my attention, I just can go Google it and take it from there. But anyway, they were talking about AI being in. Is it another .com bubble? And I'm just kind of laughing because, you know, every new technology that comes out that gets widely adopted has periods where everybody gets overly excited about it. The stocks end up getting overpriced because the optimism is so thick you could cut it. And then when they find out that, hey, wait a minute, this it's starting to slow down, even though it's hitting their projections. At some point in time, those projections, nothing grows, 40 or 50% a year forever. That's just impossible. As it starts to slow down, then the prices come crashing down, and not as much as it used to. At least, knock on wood, it hasn't the last 3 or 4 times this has happened. But you go back to pre-internet days, it was mind-boggling just how far away share prices could be get removed from the underlying values of the companies. And I don't see a lot of that. I mean, the whole market today probably, it's within a range of normal. It's on the high end. But when you look at how fast the economy is growing, that's what's just flabbergasting. I mean, I would have never believed that you'd have the increase in GDP, gross domestic product. Basically, it's a measure of how the economy is doing. And you can argue about these things all day long, and tons of economists do, and it's one of the reasons that so many financial publications do so well. Everybody's got an opinion, and they all like to air it every day. But anyway, what's interesting to me is if you look over the years, normally they're not typically out ahead of what's happening in the markets. They're actually reporting on what's happened in the most recent past. So, and the projections, if you looked at the projections, they're not that good. You'd do just as well flipping a quarter, which I think is kind of interesting. But for you investors out there, especially those that are getting ready to retire, and you're starting to get worried, and you don't want to take any more risk. Well, if you've got an enormous amount of money, then you can do that. If you've got millions of dollars, you're in the top 1/2%. You don't have to do anything except for treasuries and CDs. And but if you're like, even the average household is actually way below where they need to be able to generate the income that would replace their income from work. Now, no, and by the way, hardly anybody ever gets to the point where they're replacing 100% of their income. So if you're one of those people, pat yourself on the back. I'm telling you, I've been doing this for an extremely long time period. And the data that I see through the Wall Street Journal and Bloomberg Magazine and other magazines out there, Barron's, they're right. It's really difficult to accumulate enough money to be able to retire. And then once you do retire, to put up an income plan that's going to keep up with inflation. That it's hard to do. It's not easy. So that's why I stay so busy. And incidentally, the easiest ways of doing this. I've been doing this for 30 years now, and there are some easier ways. Now, some people may not like what I'm about to say, and I get it. It's hard. But if you take a 5% of whatever your savings are, it's really difficult to generate more than 5% in income, because remember, you're going to have to, that 5% is going to be the starting point. It's going to have to go up over time because prices are not going to stop going up because you retire. So inflation is going to stay here whether you're working or not. And that's something that you have to kind of factor into your plans. Oh, not that hard to do, but it is very difficult psychologically when you're in the accumulation phase, because you're probably going to have stocks in your portfolio, and stocks fluctuate a lot. And I know I get an awful lot of people that come into the office or call, and well, this is what I would like you to do, and they want me to earn 10-15% a year on all their savings. Okay. Oh, they want me to do it for free and no taxes either. And well, if I could get that, and I know I complain too much, but anyway, the bottom line is, realistically, if you're going to take out 4 to 5%, that's one of the reasons that I started talking about annuities 3 or 4 years ago, because they will guarantee rates that are generally higher than that. Those are affected by a lot of things. The length of time that you're committed to go to the annuity, the longer you're willing to commit the money, the higher the interest that they'll give you. So, your age when you start taking it out, that has a big impact on it. And there are lots of other things that you need to look at. So if you want to, if you wanted to talk about that, if you're interested, just call me. And you can go to bullingtoncapital.com. You can set up a phone meeting, or you can come into the office, or I can meet you somewhere. It's no big deal. And I think they're a great thing. There's a portion of your money that you'd like to cover your basic living expenses with pensions, Social Security. And if not, then that's one of the areas where annuities are very helpful, because when you know you got a specific payment and you'd like to have it covered no matter what happens to the stock market, okay, then that's where that comes in, and that's where it has a place. And I guess the reason I'm talking about that so much is that I've had some people calling in, and especially the younger ones. They complain a lot. I don't want an annuity. I don't need an annuity. Well, yeah, but you're not the the rest of the population. Yeah, the vast majority could benefit pretty significantly from it. And at some point in time, you may get there. And I hope you all are multi-millionaires and don't have to worry about that kind of thing. You could just live off the dividends. You could have growth stocks. Take one of the growth indexes that pays dividends, and dividend yields probably 2.5%, 3.5%, somewhere in that range. That's because these are growth stocks, growth stocks that pay dividends. And so if you got $10 million, you get a 3% taxable dividend. That's going to give you $300,000 before taxes. Awesome, that's a great thing. But if you're not in that category, then most people aren't. Most people don't have 10 million. Most people don't have $1 million. In fact, just Google that sometime. So if you've got less than that, then you really need a higher source of guaranteed income. You can't really afford, even though the returns might be higher in the long run, to be able to put your money in the stock market. You have to weather an awful lot of storms. And I've seen the market's been down more than 50%, I think 4 times in my lifetime. Now think about that. I'm in my early 60s. 4 times in my lifetime. And by the way, it's not like it happens, every 15 years. It's not like that. You cannot count on it that way. And this is another thing that people just don't think about. And I don't see anywhere on the internet, and I'm on the internet constantly doing searches, reading articles. They've never addressed this. I take that back. Some have. They call it the sequence of returns risk. And see that when you start using words like that instead of speaking English, you're losing everybody. So the idea. And it's an important idea, and you're doing good work. You're just messing up the communication, and it's not getting through. So that's actually one of the reasons I started this show. I'm like, I am so tired of hearing all this crap. And having said that, my favorite financial magazine is Bloomberg Business Week. And, yeah, there's a ton of stuff in there. You probably remember Business Week from a long time ago. And Bloomberg bought them. And Bloomberg has a terminal. It's a service. I've got that as well. And if there's anything you want to know about money, I don't care what it is, it's in there. So it is massive, and it's one of the tools that I used to build one of my stock models. And I really like this stock model. But I'm telling you, and the stock models, the performance has been better than the S&P for a very long time period, which also, a lot of people say, well, it's impossible. You can't do that. No, it's not. It's possible. It's difficult to do because if you're going to beat the S&P, and what most people think is that it's going to be a CD that has a 10% or higher yield. That's what they think you're doing. Good luck with that. And by the way, if that ever comes back again, I remember those days. I remember very, very well. I think I was in high school. When you had money market interest rates that were in the mid-teens, it's because the prices were going up in the mid-teens. It was called inflation. Talk about brutal. I mean, the price of everything was going up. And most people, they really didn't realize a lot about it. Actually, they didn't really know why or what was going on. They just knew prices were going up, and it was really, really difficult to keep up. And we'll talk a little bit more about that. I'm going to slow down here for a minute because I'm going to have to take a quick commercial break. This is Bill Bullington. I'm right here on 1420 every Saturday from 11 to noon. You can call us at 216-901-0945 if you have a question. And I'll be back after these commercial messages. except that I can't hear myself. And I hope I'm broadcasting. So anyway, yeah, there we go. This is Bill Bullington. I'm here every Saturday morning. Sorry about that. Sometimes that's the way things happen. Actually, it happens a lot. Not in here, but everywhere. You know, I was just thinking about that as we're going through the commercial break. There's one of the big lead articles in this month's Business Week, Bloomberg Business Week. They purchased that publication. Is AI another .com bubble? And of course it is. Everybody gets excited about the new technology that comes out, and they start selling a whole ton of it. And they start projecting those sales out 10 years into the future as if it's not going to slow down or as if it's going to accelerate over that time period. And you know what? I've never seen one of these periods last a full 10 years. I mean, 4, 5, 6, 7. Yeah. And you can argue, well, they increased every time. Yeah, well, where the revenues are going up by more than 10% year over year in a big company. That is incredibly difficult to do. I mean, think about that. If you're a billion-dollar company, which is pretty small anymore, that's actually a lot of small caps, to increase your revenue by 20% means you got to go find, first of all, you got to convince your old clients to buy another $1 billion worth of stuff if you're selling stuff that's not a service. And then you got to go convince $200 million in revenue out of people that have existing funds that can spend that money. And that's just not that easy. It's actually really tough. But, you know, we can do it. We've been doing it for a while. Don't know exactly how long. Nobody ever does. But what I can tell you is this, that in countries like America, things work really, really well. What I think is really interesting is if you look around the world, China's been on a tear. Now, they do a lot of things that very quickly, and they don't have to have a lot of, they should have a lot of supervision, but they can get a lot of go-aheads from a government that's run by one person. That's kind of an advantage. This is my own opinion, by the way. So if you had a single person making all the decisions the way that Trump wants to, I get it. You know, it would be faster. If you were making really good decisions, it would be better. But if you're hesitant to, and this is where China's leader is extremely intelligent. This dude is off the charts smart. When something's not working, they try to fix it to get it to work. When they finally realize, and they're hard to give up, but they're constantly adjusting and trying again. You have to do that. You can't keep sticking to something that's not working and think it's going to work one day. It's going to work one day. That's really tough thinking. I've seen that coming from CEOs of really big companies, and they just drove their companies into the ground. You know, because they couldn't deal with the data. They couldn't deal with being wrong. So that's the blessing and the curse of having an individual who can make major changes quickly. If they are convinced that they're not wrong, and they are, that's not going to be good. It's going to be very bad. But if they, so anyway, I feel bad about my wandering brain. It's just how it goes. I'll go from one topic to the next. It's pretty interesting, though. I was reading about that, and I've got a couple magazine articles, and it's something that a lot of people in America, I think they call it ADHD. But actually, I read pretty quickly, so it's not a big deal. And going from one subject to the next is kind of, you almost have to do it these days, especially when you're managing money, when you're looking at your future. Everybody wants something that's super simple, and that's one of the reasons annuities are so popular, because they're simple. They are super simple. And the returns that they get that they're willing to guarantee, at least for now. Right? The rates change a lot. They're very competitive. They're very good. So it depends on your age, because they're going to guarantee to give you an income for the rest of your life. And you can actually leave that income. You could do it jointly. So if you have a spouse, something happens to you, the income will continue to go to your spouse. And that's a very nice feature. And then you can also, if there's money left over before you both pass away, it goes to your beneficiaries, your kids, or whoever you name as a beneficiary. So, and the interest rates depends on your age again, because the older you are, less likely it is you're going to live longer, right? That makes sense. So if they're going to pay some money out and you're in your mid-70s, it's not like you're 50. Okay, so a 50-year-old's not going to get, they can do it. They can buy an annuity, convert it to income, and take it for the rest of their life. Okay, but they're going to be living a lot longer, so the amount of income they're going to get is going to be smaller than the amount of income for somebody who's 70. Okay, and just kind of common sense there, I think, but it can be kind of confusing. I guess that's why I still have a job, but one of the reasons anyway. And so this is what I like. When I get to Social Security age, when I'm not penalized, I am Social Security age. I can't believe that. It happened this February, and it's just mind-boggling. I mean, this can't be true. I can't be that old. So anyway, I could turn it on if I want to. I don't want to. I'm going to wait until I get full Social Security, and then I'm going to take it. I'm just going to reinvest it. I'm going to open up accounts and have the money go right into the accounts. So that's me. Everybody's different. Some people need to, it's a very, very successful program. I'm going to say it's one of the most successful programs that's ever been invented. It kept people off of from falling into poverty. That's actually what it was started for. Way back in the 1930s when they first started making the payments out, and it's done very, very well. I think it's one of the better programs out there. And I know the rich people like Elon Musk, they hate it. They hate it. You know why? Because they're rich. They don't need it, and they don't like having to pay taxes into a program that they're not going to benefit from. And they do benefit, by the way. They still get it. You don't not get Social Security because you're rich. So you pay into it, you're going to get money out of it. And so I thought that was interesting. Sorry to meander so much, but when I start thinking about this stuff, a really good rule of thumb for how much money you might want to put into an annuity, it's going to be different for everybody. If you're looking for current income that you want to get, you can get income. The one that I like the best, you have to wait for 12 months to turn it on. Now, there are others that you can take right away. You can just turn it into an immediate annuity. There are lots of issues you have to consider before you do something like that, because they all have different rules governing how you can get out of them. Some of them have one of them I use has a rider on there. That a rider is like an insurance policy that you can strap to the back of the camel, which is the annuity. And a rider guarantees that you can't get back less than you put into it. So if you put money into it and then you started taking an income and then you passed away, and I should say your beneficiaries can't get less, they'll take a look at how much you put in, how much you spent, and if the balance, because the market's crashed, is a lot lower than that, they will make your beneficiaries whole again up to the point where it's what you started with minus what you took out. So if you didn't take anything out, that's great. And there's another rider that you can add to some of the products that will give you that, plus the guarantee that the principal goes up by, I think it's 4% each year. So, and by the way, these numbers are changing constantly. It's one of the things I really don't like about the business. It's always changing, so keeping up with it is a lot. And not that I can't. We've been doing it a long time, and that does help. But yeah, if you're looking for guaranteed sources of income, it's one of my favorite. And like I said, what I would try to do is get your basic living expenses covered by guaranteed sources of income, things like pensions, Social Security, annuity income. Those are the three top providers of secure income. And then when you're looking at the growth side, stocks is where a lot of people get really excited because their stocks, it's exciting. I've got a model I run through Goldman Sachs, and because we have a relationship with them, you don't have to meet their normal requirements. I think their normal requirements are $500,000 for an account. That's a lot, for the average person, and that's just for like this one account. So, with the relationship we have, it's nowhere near that. I don't even think it. I think it's under 50,000. Yeah, I'm pretty sure. We've got some other programs through Fidelity that will go down as little as 5,000. Not that I want to do that. It's a lot of work, but it's whatever you need, whatever you think you need, and lots of different programs in there. I like the pure momentum models. That's the ones that I'm running through Goldman Sachs, and basically we're measuring the current speed of the top 40 stocks in the stock market. So basically Russell 3000. And that is the stock market now. It's 99% of all publicly traded companies, and there just aren't that many publicly traded companies as there used to be. So 3,000 is a lot. It's more than you need. But if you want to focus just on the top 1.5%, those that are going up the fastest in that whole group, that's a good strategy. And there are some funds out there that do some similar things to that, and their returns are all within 1% of each other. So, there's just so many options today. I think that's one of the hard parts about trying to figure out what you're going to do in retirement. You have an unbelievable number of options that you can invest in. And it takes a long time to understand the differences between them. And a lot of them are not even different. They're just called something else, which is very confusing because you spend a lot of time reading the prospectus and you go, wait a minute, this is the same thing that the Russell 1000 Growth Index is doing. And the Russell 1000 Growth Index there's another one that's only got 40 stocks in it, and they're all doing the same things, but they're calling them something different. And there are slight differences, like the difference between the 100 and the 40 stocks. There's 60 stocks there. Does that make a difference? Well, in the past, it's over the past 15, 20 years, it would have bumped up your returns a little bit by holding fewer stocks by about 1% or so. And you can't guarantee that either, by the way. And it's because as soon as I say that, sure enough, that one's going to underperform. Because that's what they do. They love that. That's one of the things I think the stock market was built to do, is to frustrate you. And it does get pretty frustrating from time to time. But anyway, a reason that stocks do as well or have done as well as they have is because a lot of the companies will come in and they're going to do very well. Some of them do very well for extremely long time periods, extremely long. And but others come in and do really well for a short period, and then whatever that phase was goes away or changes, and they're out of the loop. A lot of those companies end up going away. That's why, when I first started in this business, I was reading and I was looking back, and I had to pay myself for this data because the firm wouldn't even pay for it. They wanted me to, the firm that I was working for, they wanted me to focus on their stocks and their ideas. They didn't want me to think for myself. And that was pretty common back in those days. And I was like, I don't know if I like that too much. So I spent the money myself. And I had to go take classes and learn how to code and write programs and build some of my own models. All of which, there are probably 3 or 4 versions of any idea that you could think of that's like a legitimate idea. When I say legitimate, I mean, it's really got rules, and they'll argue about that. I'll say, well, I've got rules. Okay, what are they? Well, if I like it, okay, how do you define like it? What does it have to have? Do they have sales? You don't know if they have sales. By the way, 9 out of 10 people have no idea what the sales are out of their top 3 stocks that are in their portfolio. Most people don't know what their top 3 stocks are because they're buying funds. All I needed to know was how good it did. No, actually, you don't. If you keep doing that, you're going to run into a wall. Ask anybody that invested in the NASDAQ stocks in the late 90s. Some of them are still not back to where they were. So, but they were doing really well, when you bought them. And I feel bad. I know I'm offending some people. I really don't mean to. But you have to think. You have to stop and think a little bit. I only got about 30 seconds here before I got to take a real quick commercial break. If you'd like to call us, the number is 216-901-0945. And I promise not, I only raise my voice like this on my radio show. This is not my normal. See, now you're getting it back. But I never talk to you like this when you come into the office or if you're on the phone. So I'm going to take a real quick commercial break. This is Bill Bullington right here on 1420. I'll be back after these commercial messages.
Have you ever had one of those days when nothing really goes your
Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon, right here on 1420. If you hear anything you'd like more information on, feel free to give me a call, 330-664-0700, or go to my website. It's Bullington Capital Management. And I just thought this week it was pretty good. The Bloomberg Business Week magazine, something I just subscribed to it. But there was an article in there, and it was calling, it's actually dedicated to artificial intelligence. And actually on the front pages, they're looking at Gavin Newsom, and he's writing a battle plan for America's hapless Democrats. Whatever that means. Anyway, I liked the articles that they had, especially when it was talking about AI. And very, very helpful. And the article's not even that long. That's one of the things. These guys it's unbelievable how much things have changed. I remember as a kid, I would start reading a magazine article, and 15 pages later, you might be halfway done with it. They weren't exactly that long. But today, they're putting in a whole ton of information in 2 or 3 pages. So it's pretty interesting. You can really pick up a lot of information in a relatively short time period. And that's just one of the modern conveniences, I guess. Anyway, so they're trying to figure out if they thought AI was just another .com bubble. And I don't know if you know what a bubble is. A bubble is basically stock prices that have risen in an industry group, that have risen well beyond any measurable calculation based on sales and profits, because a lot of them don't even have sales yet. A lot of them don't have profits. At some point in time, if they survive, they're hoping that they're going to have big sales and big profits. And one of the problems with having a bubble develop before that happens is that after they're growing, after they're profitable, they can afford to pay all their bills and they have some money left over at the end of the quarter or month, and the share price is a lot lower than it was when they were losing money. And that doesn't make sense, right? Welcome to the stock market. And you know what? It's always been that way. I can't remember a time when it wasn't that way. I remember when I first got in this industry, you had to have a book to look up the symbol, for the stock that you wanted information on, so that you could type it into your terminal, And it took about, 10 seconds or so. They would bring up a quote. And then you would pull up their information if your firm had subscribed to some of these data sources to find out what their sales and profit margins and what their earnings were. Actually the reports back then were pretty concise, not like they are today. Today, there's nothing that you can't know about a company, legally anyway, but that's not in a publication somewhere. And so I use the Bloomberg terminal. They are expensive, but through all my experience in testing, they were one of the more accurate ones. So I really like that. And they also provide a wide array of direction. They have markets. I don't trade bonds per se, big blocks of bonds for my clients. It's too difficult to do that. And by the way, I use Fidelity for that. If you're going to invest in treasuries or CDs or corporate bonds, and something that we offer in addition to the asset management. So if you'd like to learn more about that, just hit me up. Give us a call, 330-664-0700. And anyway, back to this article I keep referring back to. Is AI another .com bubble? And they go on to talk about it. And yeah, it looks pretty similar. And there was this guy, I remember his name was George Gilder. He was kind of like a sci-fi writer, but he was also giving advice on individual stocks. And it was just mind-boggling that how much everybody used to hang on this guy's words. And the prices, they just got so far ahead of themselves. I remember looking at it going, I can't believe I'm in America. I cannot believe people are that dumb. They're paying 20 times annual revenue. Now, if you know anything about valuation, the average for the S&P is like 4 to 5, and that's high. 2 to 3 is more normal. Right now, it's around 4 to 5. That's the average. Some of them are a lot higher. Some of them are lower. Okay, but you're at 20. 20. I mean, think about that. You're supposed to be 4 or 5, and you're at 20. That's like expecting a 4 to 5-year-old to do what a 20-year-old might do. It's not that far off, actually. And so, needless to say, it's one of the reasons people were so upset. And you look at the early 2000s; those valuations crept up unbelievably high again. They corrected. The correction was almost 3 years. And then when it finally clawed its way back, I think it was the first part of 2008, I think it was November, actually, 2007. It finally got back to where it was in 2002. It goes down further this time than it did the first time. It was more than 50%. The good news is it was shorter. It was faster down, and it rebounded quicker. So that was the good news. But, I mean, there's a 10-year period there where you made nothing. There was one 10-year period where you were negative close to 50%. Think about that for a second. And that's one of the reasons I started doing annuities. I'm like, hey, you can't get close to retirement and expect to see 50% declines in 10 years. So you're not going to have to spend any money for 10 years. And if you do, you run the risk of running out of money. That'd be horrible. I used to get calls all the time, people asking about that. Well, that's one of the reasons that I started talking about it. Now, it's not the be-all, end-all. It's a part of your plan. Your plans don't have to be super complicated either. Mine's super simple. Got a couple of annuities. I've got managed money. I have some money I manage myself. And, the money I manage myself, I'm running my own screens and through the Bloomberg terminals and going in, downloading the stocks into my portfolio, and there we go. And I come and rebalance it whenever is necessary. Depends on the model that I'm running. So we've got quite a few of those, And my favorite, one of my favorites recently, it's actually a model from Fidelity that we have them using for some of our clients. And it's a market cap weighted model with individual stocks in it. That's kind of wild. By the way, as I'm saying this, it's very new to us, the Bullington Capital. We just started using it a few months ago. It's been around for a long time. I've been looking at it for an incredibly long time, and I just decided to give it a shot a few months ago. I'm glad I did. I understand exactly what they're doing. I like it. I think it's very beneficial. There are some things in there that if you're not really an investment professional, you might not understand. And but a lot of people do today. But we have to make sure as a registered investment advisor that's licensed, with the SEC, with the Ohio Department of Securities, you better know what you're doing. The bottom line is you've got to know, because they come in and look at your books, say, look at what you're doing for your clients, what kind of conversations you have with them. It's kind of wild. So we have to document an awful lot of stuff and try to do the very best we can to make sure that you understand what you have. And that's what I think is most important. The vast majority of people, and by the way, this has not changed. I'm not picking on the current generation. When I first got started in this industry, I was 25. Okay, that's when I first got started in this industry. I worked in a couple others before that. But when I got started in this one, I was 25 years old. People had no idea what they were doing. You couldn't get a lot of really good data on what was in your portfolio. It just didn't exist unless you had individual stocks. It was really expensive. But today, you can find out everything there is to know about those portfolios. It doesn't help that much. I mean, if you're young, that's fine. But it's a long road. What's going to happen? What happens to growth funds when the growth slows down and they raise interest rates at the same time? Well, I'll tell you what happens. It's 2007, 2008, 2009 when the market it was down a lot. And actually there was some overvaluation there. They were definitely selling a little bit ahead of where they should have. But you take the overvaluation and then you throw on there rising interest rates and an economy that's slowing. Normally when they raise interest rates, that's because they're trying to slow the economy down. The Fed is. And it was successful. And you just hate the fact, though, that the markets react so violently. And that is I don't know if they'll ever figure that out. I don't think so. But and if they do, then I won't have a job. So I'm not really. Actually, I really wish they would. I would really like to do something else. Just kidding. But anyway, when I was talking about the Chat GPT, that was one of the things that, it's coming on. And I have clients sending me articles and saying, look at this. And a few of them have already invested in some of the software packages that are making their investment decisions for them. Not spectacular. Not spectacular. Actually, not even good. And I don't know if they're doing it wrong. Because they wait until they lose money and then they call me and they, hey, what? Well, this is why I'm not using it. It's not really ready as far as I'm concerned. Not for the general masses. It will be. I have no doubt about that. But at some point in time, and those kind of things take a long time. So if you've got, if you're within 10 years of retirement, I don't know. That at the rate that it's going, and what I know about the general public, it's probably around 8 to 10 years when people are extremely comfortable with it and are able to do it, and it's going to work really, really well. They've got a lot of issues to work out with that. I mean, a ton of issues to work out with that. And what's not helping is that you've got a bunch of people out there that are hackers they're very good at what they do. And that's another thing. Maybe AI will help with that, but I'm just not sure. So I've only got a few more minutes here. I forgot to tell you that, you could call in and ask questions. you can call me in the office if you'd like to. My website's bullingtoncapital.com. And if you go to the contact us page, it's got all my contact information there. You can actually just jot an email down from there, from the web page, and I can get back to you as quickly as I possibly can. But yeah, I still have a few more seconds here. One of the articles, by the way, for you men out there that are by the age of 50, they have a machine that battles prostate cancer with sound. And some of it's non-invasive, some of it. And so that was sounded pretty good, because that's a big problem today. And if you could keep people healthier longer, it's a lot cheaper. So pretty interesting. There's just a whole ton of things that are happening. That's another thing. There's a ton of stuff out there that's kind of distracting. And so what are the most important economic facts that you could pay attention to give you an idea of what may or may not happen in the next few months? Well, you can read the Fed's, go to the Federal Reserve. You can read what they have to say, because they've got really good data, and they're pretty transparent. They'll tell you what they're seeing and what they're expecting and what they might do. Very boring, and they use a lot of 3 and 4 syllable words, so you might have to get a dictionary of financial terms. But anyway, I've only got about 60 seconds here. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. Sorry I ramble so much, just a habit. You can call me 330-664-0700 if you'd like to get together or you'd like to set up an appointment. And with that, I'm going to let you go. Have a good weekend, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.